Here is the conclusion of the Unit 10 exercises. In Exercise 5, we once again have the Plainview Oil Company. Same setup with just different numbers. So let's start by figuring out what our total cost is for this particular well. Well, they spent $6 million to acquire the land. They spent $870,000 drilling wells. They spent $20,000 transporting the equipment to the site, and they spent $100,000 to build the oil derrick. So in this example, just as in exercise 4, they spent $7 million to get the well up and running. And because it's a natural resource, its salvage value is going to be 0. We're going to divide that depreciable base by the estimated life in units. In this case, at the time that they purchased the land, they expected the well to produce 250,000 barrels of oil. So let's spread that $7 million in cost we're going to get rid of over the life of this asset over the 250,000 units and get a depletion rate of $28 per unit. During the first period, the first year that we had here, they extracted 65,000 barrels of oil. If we multiply that 65,000 barrels times our $28 per barrel depletion rate, we're going to come up with a depletion expense during the current year of $1,820,000. So when we record this, we're going to debit depletion expense for that $1,820,000. We're going to credit accumulated depletion of oil well for that same $1,820,000 to record the depletion on this little Boston well. Then during the second year, they're going to go through and they're going to make a revision to their estimate. They believe that this well still has 259,000 more barrels of oil left in it. So the historical cost that we're going to use is that $7 million. Accumulated depletion is that $1.82 million that we recorded during the first year, bringing us a net book value on this well of $5,180,000. Our remaining units of production from our estimate is 259 grand. So if we take that $5,180,000 of current book value, divide it by our new estimate of 259,000 remaining barrels of oil within this well, we're going to get a depletion rate of $20 per barrel. And during year 2, they extracted another 65,000 barrels, which means that the depletion expense that they're going to record during year 2 is $1.3 million. They're going to record this just like they have in the last entry, which is a debit to depletion expense and a credit to accumulated depletion of oil well for $1.3 million. And we recorded depletion on this little Boston well. In exercise 6, we're going to deal with Macrs. And Macrs is the depreciation method that you have to use for tax reporting purposes. So this methodology takes the decision out of the company's hands about useful life, about residual value even, and you're told how long you have to depreciate something over and what method you have to use to depreciate it by the IRS. So our company is Lumberg, and they purchased a truck with a total cost of $60,000, and they're going to prepare the depreciation table for this asset according to the Macrs system. So they need to go through and look at this table on the left side and see, okay, what is the type of property that we have to consider the truck to be in. And you'll see in the 5-year property section, it says includes automobiles, trucks, computers, and peripheral equipment, and office machines. Well, we don't have an option here. IRS is telling us that for the purposes of tax reporting, we have to depreciate this over 5 years, and we have to depreciate it using 200% declining balance, or the double declining balance method. And they even give you these nice little numbers. What do those numbers mean? They are the percent of the depreciation base that you have to depreciate during each year. So let's go and set up our depreciation table. Start by filling in what type of asset this is. It is a 5-year piece of property. That's the classification that truck fell under, which means we need to use the 200% declining balance method. The year that we purchased it is 2018. It had a historical cost given in the problem of $60,000. Well, let's multiply it by the Macrs rate. And the Macrs rate, according to our information in recovery year 1, was 20%. So let's multiply that 60,000 by 0.2000. And if we do so, we're going to record $12,000 worth of depreciation during year 1. In year 2, 2019, well, our cost hasn't changed. It's still $60,000. And our Macrs depreciation rate table tells us that for 5-year property in year 2, we have to depreciate it by 32% of its cost. So we're going to multiply that by 0.3200. And in year 2, we're going to depreciate by $19,200. And we're going to repeat this process all the way through. And each year we're going to multiply our $60,000 historical cost by the amount that we get to depreciate by according to our table. It's 19.2% in year 3, which means in year 3 we're going to record a depreciation expense of $11,520. In 2021 it is 11.52%, so let's multiply that by 0.1152. And in 2021 we're going to have a depreciation expense of $6,912. In 2023, $60,000 cost, it's once again 11.52%, meaning we're going to record another $6,912 worth of depreciation. And in 2023, we are going to take that $60,000 cost and we're going to multiply it by what the table tells us is 5.76%. So 0.0576, multiply that out. In the last year, we're going to depreciate by $3,456. And when we add up all of our depreciation expenses, it totals $60,000, which was our historical cost. So 2 questions you might have. What happened to residual value? IRS doesn't allow it. You have 0 residual value for everything for tax purposes. So you always need to depreciate the entire cost of the asset over its life. And the bigger question is, hey, it's 5-year property. Why are they filling in 6 years worth of depreciation if we're depreciating over 5 years? And the reason being is a thing called the half-year convention. And what that means is they had so much trouble with people trying to manipulate the time that they put on the books that regardless of what part of the year you put it on at the time of purchase, you could put it on January 1st, December 1st, October 19th, whatever random date you want. You don't get to record the partial year during the first year. You have to assume during the year that you purchased it that you used it for exactly half of the year. Think about it this way. If it was double declining balance, which it is, and it was 5-year, straight line rate should be 20%, right? 1/5 of it. And if we doubled it, that would be 40%. Well, as you can see from the table, we're only taking 20% off during the first year. That's because we're only assuming that it's going to be a half a year. And the 6th year is that last half of a year. I know it's confusing, but for every class of property we have, be it 3-year, 5-year, or 7-year, you're going to assume that you're putting the property on the books in the middle of the first year, and then you're going to have to record an extra half year worth of depreciation in the last year that they